When it comes to government spending, the Dutch have an extremely conservative reputation. So much so that after bailing out their banks in 2008, they cut government spending by so much that they prolonged their recession compared to neighboring countries such as Belgium. However, with the COVID-19 epidemic having reached Dutch shores, the Dutch have announced sweeping government spending plans to cushion the blow. Is this economic crisis fundamentally different than the last one, and will the Dutch economy be able to recover more quickly from it, or is it more vulnerable than we would expect? In this video, I will discuss both the strengths and the vulnerabilities of the Dutch economy when it comes to the coronavirus-induced economic crisis. Furthermore, I will discuss how the government has announced it will respond to the fallout. If you are interested in this type of content, you can really help me out by subscribing to the channel. This way you will be kept up to date of new videos on central banking, finance and economics, even in times of global pandemic. The economic crisis that will follow after this coronavirus outbreak will be fundamentally different than the last one. Our current crisis is the consequence of an external shock. This is economists speak for an event that happened outside of the economic system. In this case, the external shock is the outbreak of the virus. On the other hand, the last economic crisis was a consequence of a massive debt and asset price bubble that popped, an internal shock. What is also unique about the COVID-19 economic shock is that it hits supply and demand simultaneously. What do I mean by that? Well, on the one hand, it means that the supply of goods and services will decrease. For example, think about all of those cancelled parties, events and flights. On the other hand, it means that the demand for these goods and services will also decrease. Think about all those people isolating themselves, no longer visiting restaurants and no longer wanting to travel, even if they could. The Dutch economy will certainly take a big hit, but how much? Nobody knows for sure. That being said, prominent economists estimate that for virus-hit countries like the Netherlands, the annual economic output could take a hit the size of 7 to 10%. And I am sad to say these are optimistic forecasts. They assume that the economy will fully recover after being in lockdown for a couple of months. This is only possible if firms and banks will survive the crisis. If enough of them go belly up, it might take a long time for the economy to recover. Now this is the general case, but what about the Dutch case? How vulnerable is the Dutch economy? The economy of every country is unique. That means that each of them has their unique strengths and vulnerabilities when it comes to the fallout of a pandemic-induced economic crisis. Let's first discuss the strengths for the Dutch economy. The first strength is a consequence of the Dutch attitude towards government debt that I mentioned earlier. Current government debt in relation to the size of the economy is about 52%. This is well below the 60% guideline of the European Commission and is considerably lower than a country like Italy, who has a government debt of 134%. While there are now many economists that do not consider higher government debt levels a problem per se, the government debt level is very important in the context of the Eurozone. The reason is that these countries do not have the complete and full backing of their own central bank. Rather, they have to rely on the European Central Bank. As a consequence, private investors are not always willing to lend to European governments at the same interest rate. If you want to know more about this, and if you have not done so already, check out my previous video on this very topic. That being said, for the Dutch economy, its low government debt levels are a strength. It means that interest rates are relatively low and there's lots of room for increased government spending. Another advantage of the Dutch economy is its competitiveness. In fact, the World Economic Forum ranked it the fourth most competitive economy on Earth in its 2019 ranking. It went into the current crisis with record low unemployment and relatively low income inequality. This means that people have some buffers. It also has a well-educated population, making it easier to work from home, and it has an extremely productive local farming community, making food shortages as a consequence of border closures very unlikely. But that is not all. Yes, the economy is highly competitive, but it also has a relatively generous safety net for those who will be hit hardest by the crisis. In the Netherlands, everyone has basic health insurance because it is required by law. Furthermore, employees have decent protection against being fired without good cause. And finally, there are fairly generous unemployment benefits. Based on all that, you might think that the Dutch economy is in an excellent position to deal with the economic fallout from this virus. But there are some significant vulnerabilities about the Dutch economy that not many people know about. First of these is that debt in the Dutch economy is actually very high. Remember that statistic that government debt is only at about 52% of economic output. Well, that is only looking at the government. There are more actors in the Dutch economy. If we consider the total debt of the Dutch economy, we get a completely different percentage. Total debt to economic output was a whopping 325% in the second quarter of 2019. At that time, government debt was still 59%, company debt was 165%, and household debt was 101%. To put that big total debt number into perspective, the Dutch love to lecture the Italians on borrowing too much. But total debt to economic output in Italy is only 257%, and that of Greece stands at 295%. Yes, these countries are less indebted than the Dutch. Sure, they are vulnerable because of high government debt, but their company and household debt levels are much lower. The Netherlands is vulnerable because of its high private debt levels. That brings us to a second weakness. The Dutch economy is hugely reliant on other countries. How reliant, you might wonder? In 2018, exports accounted for 84% of GDP. That is massive. Sure, you need to correct this for imports, which were around 73% of GDP. But that still leaves a trade surplus of about 11% in 2018. That is still huge. Many borders are being closed, even within the European Union, and global demand is falling everywhere. This means that the Dutch economy is exposed. It could also be exposed for a longer period of time because not only does it need to take into account its own response to the virus, it will also be affected by the actions of other governments. What is more, the virus in China already cost the Dutch export sector in the first quarter of this year. Now it is hurt by a drop in European demand. And if the virus hits other continents after Europe, then the Dutch will still feel this lack of foreign demand long after the virus has left the Netherlands. But sadly, that isn't all when it comes to the exposure of the Dutch economy to outside forces. The Dutch are massive savers, this is well known, but much of those savings are in their giant pension funds. These funds are so large that they can't just invest everything in the Netherlands. Dutch pension funds have invested much of their money abroad. With stocks and bond markets nosediving all over the globe, the Dutch pension funds are in trouble. So much so that they probably need to either cut pension payments for the elderly or ask for higher contributions from the young. Both will hit the economy. So while the Dutch economy seems very robust from the outside, if you dig just a little deeper, you will find that it's actually very exposed. But what will the politicians do about that? Will the frugal Dutch start spending? Or will they keep their hands tight on the purse? Over the past years, the Dutch finance minister Wopke Hoekstra has built a reputation as the leader of the Northern European fiscal hawks. This group includes countries like Ireland, Denmark and the Baltic states, and they were until recently arguing for less government spending and less risk sharing between European governments. The Dutch even went so far as to cut government spending significantly just after the Great Recession of 2008. This is touted as one of the reasons why the Dutch economy was very slow to recover from that crisis compared to its neighbors, such as Belgium. Therefore, it surprised some observers when the Dutch cabinet announced that they were willing to increase government spending by at least 8% of GDP to cushion the economic blow of the virus. This was, however, not a very controversial move because this is truly an external economic shock. Saving banks was more difficult for Dutch politicians to explain to their constituents because these banks helped cause the previous crisis to begin with. This is seen as protecting companies who are not responsible for the crisis. That being said, what are the measures that the Dutch government is taking? Finance Minister Hoekstra announced that those companies which had less work for their employees would get government support if they did not fire the employees in question. Furthermore, those companies in hard-hit sectors such as entertainment and catering could qualify for both a government subsidy and a credit guarantee by the government, making borrowing for them cheaper. Also, those who are self-employed can get a monthly grant up to the level of unemployment benefits, as long as they can show that they lost their income as a consequence of this particular crisis. Note that most of these measures are aimed at businesses rather than individuals. This might seem unfair at first, since in the US they are considering supporting households with cash. But when viewing this response, it must be taken into account that in the Netherlands there are already strong protective measures in place to protect individuals. Also, everyone already has health insurance. These measures will not be enough to avert a recession. That much is certain. But that's not the goal of these measures. The goal is to cushion the blow for companies and banks so that they may survive and restore the economy to its former glory after the virus has been tamed. So where does that leave us? Sadly, as economists, we cannot accurately predict the economic consequences of a pandemic because it hasn't really happened recently when the economy was at such a massive interconnected scale as it is today. All that we can say is that it will be bad. We can also say that the Dutch economy is not as robust as you might think, and that it is at high risk of a sustained slump thanks to its dependence on foreign demand, high debt levels and exposed pension sector. But for now it seems that the Dutch government has taken adequate measures. They should, however, be prepared to do more. The good news is that they have the fiscal room to do so. Also, it might be in their interest not to be too hard on other European countries, since these are their biggest export markets. For now, the biggest threat to the Dutch economy is that the government will want to start cutting its own budget again way too soon, just like they did after the last recession. And this will leave the economy of the Dutch slow to recover from the shock once again. That is my opinion. What do you think? Did I make out the Dutch economy as being too vulnerable? Do you think that the government will actually come through this time and rescue the economy? Let me know down in the comments.